Hello guys, welcome back to the channel. Today in this video we'll be talking about liquidity. Most traders lose money not because they can't read the chart or they can't trade, but because they don't understand the concept of liquidity, why their stop losses is keep getting hit. In this video, I will break down exactly what liquidity is, how smart money uses it to trap retail traders, and how you can flip the script to trade with the big players. So, if you are serious about mastering smart money concept, hit that subscribe button and the like button to lock in. So, let's get into it. So, what is liquidity? Why is it important? What type of liquidity do we have? Why does it matter? So in simple terms, what is liquidity? Liquidity simply means where a lot of orders are stacked. Think of stop losses, pending orders, buy limits or sell limits. Smart money targets those zones because they need volume to fill in their massive order. So they target those stop losses areas, buy stops areas, sell stop areas, to use as their liquidity, to use to feed their massive order. In simple terms, liquidity is the fuel of the market because price move from liquidity to liquidity, and liquidity is the originator of every trend. So type of liquidity in smart money concept, we have the buy side liquidity and we have the sell side liquidity. We also have the inducement liquidity. So what is buy side liquidity? Buy side liquidity are usually found above resistance level or swing high levels. Retail trader place their sell stops order expecting reversal, but smart money push price up to grab those buy stops order and then move to the downside. I will show you an example of that. Number 2, sell side liquidity found below support levels or recent swing lows. Retail traders place their buy stops orders here, but smart money traders drop price to hit those sell stop orders and then reverse to the current side. I will also show you an example of that. So inducement liquidity, this is the first pullback after a major break of structure. This is the first pullback. Is a fake low or a fake high. Price will usually come to sweep it, then move to the opposite side or to the current side. I will show you an example of that. Let me first of all give you an example of a buy side liquidity. So a buy side liquidity chart example is going to look like this. It's going to look something like this. So this leg here, this is your buy side liquidity. Remember what we said is the originator of all price movement. So look at your higher time frame, ask yourself, why is price in an uptrend? Why is price in a downtrend? It's because of liquidity. So price is hunting liquidity constantly. See, price came here, swept this high, swept it, then moved down to the downside, creating the market structure shift or your change of character, came back into a demand zone here, or you can use it as your order block, then came back, moved to the downside. Same thing for a sell side liquidity. Sell side liquidity is going to look at something like this. Price came, swept the current low, broke structure to the upside, then came back, then moved to the upside. This leg right here is your sell side liquidity. Price hunt for stop losses. And what does your inducement liquidity looks like? Your inducement liquidity is going to look something like this. Remember what we said, after a break of structure, the first pullback is usually your inducement liquidity. And price move to the opposite side. This, in this case, is going to be your inducement liquidity. So this is your buy side liquidity, this is your sell side liquidity, and this is your inducement liquidity. Not to worry, we'll be going to the live charts to see more examples later. So why does liquidity matters? Why does it matters? Here we said hunt liquidity. Smart money hunts liquidity to feed their large order. Because they have a large position to enter into the market with, they can't just come enter into the market like that. They need liquidity to do so, and they need a lot of people to buy or sell, either at a lower price or at a higher price or at a higher level. That's how smart money enter the market. They hunt liquidity. Number 2, false breakout, stop hunt, and market manipulation. It explains false breakout. For instance, as you said here, as we gave an example here of a buy side liquidity, you might think price is going to continue to the upside, but you place your buy stop here, price will come, do something like this, then move to the downside, then come back, then continue to the downside. So it's a false, in this case, this buy side liquidity, in this case, it's a false breakout. Now I'll show you how to spot it. Then stop hunt, market manipulation. You see, in a case whereby a week, you just take out your stop loss, then continue to the upside. That is not random. That is market manipulation. Number 3, entry points. Liquidity zones are often used as entry points after a manipulation move, like liquidity graph followed by a break of structure or a change of character. So that's why liquidity matters. It helps you identify false breakouts, where stop losses are supposed to be placed, how market manipulation works, and your entry point. So you can't just enter into the market anyhow, randomly. So liquidity helps add as a form of confluence for your entry point, for you to get a perfect setup. So let's go to the chart and I'll show you an example of all this playing out. So clearly you can see price is in an uptrend. So this was the recent high. So we were expecting for price to continue to the upside. But what did price do? Price came, swept this liquidity, and broke structure to the downside. So what does this signify? It signifies a change in market structure. And what do they say? That liquidity is the originator of all price movement. It means sellers are stepping into the market and they can't enter anyhow. What do? They make sure they stop early sellers that start selling from here, place their stop loss above here. What the price did, they came back, sweep them out, and then push price down to the downside. So in this case, what do we start looking for? We start looking for sales. Let me show you an example of a sell side liquidity. Let me show you an example of that. Yeah, you can see here, this was the current low. Price came, swept it out, then continued to the upside. This is your sell side liquidity, and this is an example of a buy side liquidity. So what does an inducement liquidity looks like? Remember we said liquidity originates after a change of character or a break of structure. You can see in this case we had a break of structure here and a change of character here. So the first pullback is usually your inducement. And what's the first pullback here? Lower low, lower high, and this low. This is going to serve as your liquidity. You can see price came, swept it out, because a lot of people say they saw this change of character and they saw a break of structure. They were like, price is going up, so they start buying from this particular zone. They start buying thinking price is going to continue to the upside. No, this is smart money making people believe that price is going to continue. What happens? Price came into this demand zone here and then bust to the upside. And what did we say why liquidity is important? It serves as your entry point. It helps you know where your point of interest is going to be, how you are going to enter into the market. Now you're seeing a change of character, a break of structure, and a liquidity. The next thing for you to identify is a demand zone that is close to that liquidity zone. Then you place your entry point there. Place your entry point, in this case here, stops slightly below this low. Then you target the next high. You are done. A 1 to 3 risk to reward ratio. Let's clear this out. So that is your inducement. That is your break of structure. Break of structure is the originator of all price movement. Is the originator of all price movement. So price does not just start, it's coming from somewhere, either from a old high or from an old low. You see something like this, as we've explained before, came back, swept this old high, came, created a market structure shift, go to the upside, retest a demand zone, come like this. This is how price move. Price move from liquidity to liquidity, always sweeping liquidity and testing key levels. See, price swept this old high, came back, gave us a change of character, again broke structures, break of structure. So we start looking for sell. So we see there's another break of structure. There's another break of structure here. So, and we said the first pullback after a break of structure is usually your inducement liquidity. Let's mark this as liquidity. Then, why is it also important? As your entry point. So you don't just enter anyhow into the market. You look for a demand zone here and you enter. You place your sell limit here, stops below this low. Done. You can see all we've explained here, your buy side liquidity being raided, creating a change of character and a break of structure, and price came, gave you an inducement liquidity and an entry point right here. So you enter, you sell, and we saw a perfect example of that. We saw it somewhere around here, yes, here. Price came, give you an inducement liquidity, a change of character, a break of structure, and an entry point. An entry point right here. So you can also see this example, just like the one we drew back there. Price came, swept this hold high, swept it, which is your buy side liquidity. Then price came back, shift to the downside, creating a change of character here and a break of structure here also, and a break of structure here. Then what do we start looking for? Price did not give us an inducement liquidity here, but what do we start looking for? Now we know that market has shifted from an uptrend to a downtrend. So what do we start looking for? We start looking for selling opportunity. We start looking for sales opportunity. We start looking for sales. We start looking for sales. You don't start looking for buy. You don't focus on this side. You focus on this side. You start looking for sales. You start looking for sales, and you need to be patient. In the forex market, patience is key. You start looking for safe it. In this case, if this is on a 12-hour time frame, if you go to a lower time frame, you can see clearly you have a break of structure here. Let's mark this as a break of structure, and you have an internal break of structure. Sorry, mark this as a change of character. This is a break of structure. Then what did price do? After price broke this structure, price came back, pull back to this level here. This is going to serve as your liquidity. Then again, you have gotten a break of structure, an internal break of structure, and an external break of structure. This external break of structure is your swing structure. This is just an internal structure. We'll be diving more on that on more videos to come. So what do you start looking for? You start looking for an entry point. Now price has given us something like this. Sorry. Price gave us something like this. So what do we start looking for? You see, it had a break of structure here, and another break of structure here, which is this. So what do we start looking for? This is your liquidity. Sorry. And liquidity. So what do we start looking for? We start looking for an entry point. And as I said, you use this demand zone right here. You use this demand zone. Your entry point will be around this side. Stops below this low. Target the next low. You are done. Smart money trap a lot of retail traders. You might say in some cases price might do something like this, give you a break of structure, and a change of character rather than a break of structure, then price pull back, then give a break of structure to the upside. A lot of retail traders might want to do something like this. They might want to enter from a demand zone here, and they will place their stop order here slightly below this low, targeting this high, waiting for price to come back into the zone, and then for price to buy to the upside, or knowing to them that we had a change of character here, and price gave us a break of structure to the upside and another break of structure. Another break of structure. And as we know, as SMC traders, we know that after a break, change of character, a break of structure, the first pullback is usually liquidity. So we always know that this low is going to be taken out. So us as smart traders are looking to get in from here, because we know that price is going to need liquidity to buy to the upside, because price getting here has exhausted momentum. Momentum has dropped. So what would price eventually do? Price is going to do something like this. It's going to come, stop them out, then buy from this particular zone. And they are going to be wondering, why, how did this happen? Why did price stop me out and bought from this particular zone? Unknowing to them that this zone here is liquidity, this low here is liquidity. Price is eventually going to come and stop them out. Also, as smart money traders are looking to get in from this zone here. I stop below, slightly below this low, then we target the next high. That's how smart money traders. So always look out for this thing. Let me show you if there's a chart example here. Yeah, something like this. You have a break of structure here. You have a break of structure here. And a major break of structure here also. So price came, price pull back to this level, creating this low here. So a lot of people, have said, are going to be looking to get into this trade from here. Sorry, they're going to be looking to get into the trade. It will be like, price have broke structure to the upside and price have pulled back into this level here. So price is going to keep buying. So they start buying from this zone here. They'll place, as you see in that illustration, put a stop loss slightly below this low here, and they'll target this high. So what does price do? Price came, stop them out. So we as smart money traders, we already know that this is our liquidity, because this low here was the first pullback that came after price broke structure to the upside. So we already know this is a liquidity. This low here is liquidity. Price is going to eventually come back and stop and take it out, for price to have a lot of momentum to keep pushing to the upside. So we've identified our break of structure, our inducement. So what do we start looking? We start looking for our point of interest, which is our entry point, and we use this demand zone here. And as you know, a demand zone is the last bearish candle before an impulsive move. So we'll cover more on supply and demand in more videos to come. So we place our entry here, stop below this low, and we target this high. Boom, TP hit. So that's how we enter the market as smart money traders. Here's why liquidity is so powerful. Once smart money grab liquidity, they usually use it for the reversal of the market. That's your chance of entry. After a liquidity grab, a break of structure or a change of character is confirmed, then a reversal is set to happen. Then you position yourself to start looking for entries, how to enter the market with these things in check. So your liquidity, your change of character, your break of structure, or your inducement, you look for those stuff. That's your chance of entry into the market, as you've seen in chart example I've presented to you. So to recap, stop getting trapped by fake breaker. Liquidity is the key to understanding price manipulation and timing to better trades. So drop a comment. See you on the next one. Thank you for watching. Please, if you are new to this channel, like and subscribe. God bless you. See you on the next one.